The information discussed in this presentation is current as of the date noted and is for informational purposes only. It does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary and no suggestion is made about how any specific solution or strategy will perform in reality.
I've been here now 18 years. I had a major career change when I first came here. I was in hockey. I was in the sporting industry. John Ullman, if you know, is a huge sports fan, especially with the Buffalo Bills. So when I ceased working with the local hockey team, he called me up, and here we are 18 years later. So it's been a fantastic ride. Jake's been here now a year and a half, graduated from Texas Tech. After going to Alfred State, he opened this office. He's got his CFP and his Series 65 and is in charge of all the technology, including any of mine. So, so you're up, Jake.
So, common question we hear whenever talking about retirement is, what do I need to retire? When can I retire? A lot of people have, ideas in their head, or maybe they've done a financial calculator online to get a rough estimate, but I think no matter what, you really need to think it through, because there's a lot of unexpected and expenses, different income sources that you'll need to consider, which we'll get into in our presentation here.
This is a really cool and somewhat eye-opening chart. If you start at the top there at that 7%, the cost of retirement, 7% think they can retire with 25 grand a year. So pretty much that would be Social Security, and obviously that was never the intent of Social Security. It was always to supplement retirement, not live on retirement. So this was really pretty interesting. As you go clockwise around there, obviously we're getting up to the gold, where 25% think they will need at least $1 million or more. So that's a really interesting chart for me, because I sort of look at retirement as a three-legged stool. You have Social Security, which again, I think is to supplement retirement, not live on retirement. You've got your pensions, which for the younger generations may or may not be around at that time. And then you've got your individual retirement savings, which are becoming more and more important. So this is kind of a neat chart. And obviously, as you work your way around that, the money becomes a little more, and it opens up some opportunities and freedom and options in retirement.
Now we'll look at the average retirement savings for different age groups. The first two don't really surprise me, just because people in their 20s and 30s are buying houses, paying off college debt, cars, maybe starting families. So savings, and especially retirement, usually isn't really at the forefront. When you get into the 40s, 50s, and 60s, I think that's pretty surprising to see, a maximum in the 60 age group of 215,000 average retirement savings. I mean, in this day and age today, people are spending usually at least 60 to 70,000 a year. So considering that's your retirement savings, seems hard to live on. And especially if you look at those numbers and look back, so the highest level was 215,000 for age 60. You can see, I think over 60% of people on this assume they need at least 250,000 or more. So you can see that there's a big gap in retirement savings than what people think they'll actually need to retire. And again, this is more concerning for the younger age group, because as Todd mentioned, pension plans are kind of phasing out. Companies are starting to realize those, especially because people are living longer, they're paying out a lot more than they're used to. So people are generally responsible for their own retirement savings.
This is a cool slide. I look at the vacation phase, the first of the 4 phases of retirement, sort of like the dating phase. That's when you first retire. It's exciting. You're vacationing, you're visiting, you're golfing, you're doing everything on your bucket list. You're going on your cruises. Then it goes to the anxious phase. After you get out of that, you're sort of, you see that your retirement accounts are being drawn down, healthcare costs continue to go up. The big thing that I've noticed with people in that phase is they miss the routine. They miss I'm getting up at 6. I, have my banana. I go for a little walk or a workout. I have lunch at 12. We find a lot of people in that anxious phase miss, as much as they miss the income, they miss the structure of their life. The trial and error phase, that's where a lot of people we find volunteer. They find a part-time job. Maybe they get a second home and do some rentals of that second home. Maybe they chase grandkids around, visit family. And then the last one is sort of the later phases where you just really find what makes you happy, what you enjoy, and that's what you're going to do for the rest of your retirement. So that's a kind of cool progression that we see happen quite often.
Next, we're going to talk about some common misconceptions in retirement. One thing that one of our vice presidents, Tom Snow, kind of coined the term is when you retire, you need to retire to something. Kind of like Todd was talking about, you go from 30, 40, 50 years of working and being in that structured job and kind of knowing what your day is going to look like to nothing. And some people think, oh, I'm going to love, no plans. I'll do whatever I want that day. But it can be a big change for a lot of people. So finding something like volunteer, maybe part-time work, something like that to keep you busy. Friends and family, a lot of people think, oh, I'm going to, go visit all my friends, all my family members and whatnot. But you need to make sure that they have their own lives. Maybe, your kids are busy with their kids and sports and travel and job and work and everything like that. So something to consider. And then a lot of people, you've been paying into Social Security every year you've been working. So, I want to take that Social Security check as soon as I possibly can because I want them to start paying me back. Well, if you take it as early as you can, your benefits can be decreased up to 30%, which is a big chunk, especially if that's a big portion of your retirement income. And especially if you decide to delay it, it can even increase about 8% per year. And then the belief you'll have fewer expenses during retirement. People think maybe my commute will be less or I won't have the commute at all and expenses will go down. But as you'll see in the next couple of slides, there's a lot of things I don't think a lot of people consider when they start getting around that retirement age.
The unexpected of retirement. Priorities, those obviously change in retirement. We talked about families and friends, maybe a second home. You can't borrow for retirement. We deal with this a lot, especially with parents and grandparents looking to help kids and grandkids with education. Some folks are doing really well, then they take a huge chunk out of their retirement, then 10 years later, retirement gets tough. So I'm a big fan of having kids and grandkids with some skin in the game. They can take out loans for college, homes, and cars. When can I retire? That's a huge question. One of our colleagues has a podcast, says, well, it depends. And that's the name of his podcast. And so many times that's the first thing out of our mouth. It depends on each and everybody's unique situation. And that's what makes our job so fun. Everybody's different. Consulting, we talked about 1099s a lot of times, especially with the younger generations, instead of W-2s and all the costs of healthcare and retirement plans and all the benefits and bonuses. A lot of companies are going towards 1099s where here's your money, get lost and you handle it yourself. So we see a lot more 1099 workers than we did 15 years ago for sure, just because it's so expensive for the companies on W-2 employees. I get to double up on this one, don't I? Because our marketing guy switched the slides, so I get to do this one as well. The first 5 years are crucial. Across the top there on the horizontal axis, that's within our control. So we have a software called Navaplan that we do various retirement plans for, and spending and overspending, we deal with that quite a bit. On the vertical axis, somewhat controlled depending on what kind of investments you have. Obviously, the stock market can be very unpredictable. And if we get in that fourth quadrant there with the big X, especially in the first 5 years, that can really change the long-term plan of your retirement.
So here's another chart showing some stats on some of the greatest worries when people are in retirement. You can see healthcare costs is number one. I think that's pretty common. Nobody really knows what's going to happen. People are living longer, it keeps advancing, and in the near future, I certainly don't see the costs going down anytime soon. Then you've got those unexpected expenses. This could be problems in your house or problems with a car, especially medical expenses, unexpected medical expenses. And then obviously significant economic downturn, outliving my savings and tax increases, all big questions when looking into your retirement.
Some of the unexpected ones Jake just touched on: housing costs. Obviously, roofs and septic systems in our area are always huge expenses. Uncovered health care, that's obviously a theme. Long-term care, we talk about a lot. And early in my career, I used to advise people of getting it more often than not. Now it's very, very expensive. There's very few companies in the business anymore. It's almost a monopoly. And when you lock yourself in, the benefits are never guaranteed. And I've been dealing with some awful situations where someone's had long-term care for 25 years and their benefits are getting cut. They either have to increase their premiums or take less, or have the time span when you receive those benefits cut short. So I'm not as big a fan of long-term care as I used to be. Some of the current things they have out now, especially for younger folks, which I think is a good idea, is they call them hybrid, where they're life insurance and long-term care. So many people never wanted to do long-term care because they think, gee, if I get hit by the bus, all this money's gone for nothing. So now they're doing hybrid plans where it can be used as long-term care, or if you don't need the long-term care, it's used for a death benefit. So those are some kind of cool options. Losing a spouse, we deal with that a lot as well. Obviously, you're looking at Social Security steps ups, pension survivors, and survivor options on various other investments.
So now we're going to start looking into some investments and kind of what you should look for when you're retiring. So in retirement, you've got that limited asset pool, so it's really important to protect it. One thing we like to tell a lot of people when they're in retirement and they suggest being more aggressive is, if you have $1 million, all your retirement assets, and the market goes down 50%, you're at 500,000. A lot of people think, oh, the market just has to go up 50% the next year, I'm made whole. Well, that's 50% on the 500,000. So you really need 100% increase in the market just to be made whole. That's just to get back at your starting point. So that's something we really build our investment policy around, is just really protecting against the downside. With that being the case, we also do miss some of the skyrocketing returns. Managing your risk while allowing for growth. I think a lot of people just want to put their money in the bank and know it's the only money decreasing the account is me pulling it out. That's good, but I think there are definitely ways, especially in today with rates being what they are and money markets and CDs being 5%. I think that's a great way to protect some of your assets while still getting that growth. And another thing with the kind of doing your own investments and passive investing, different assets have different growth rates. So what I mean by that, if I set up my portfolio as 50-50 between stocks and bonds today, in the next 5 years, my portfolio will probably look more like 70% stocks and 30% bonds, just because the stocks generally will grow a lot faster than the bonds will. So it's just something to be aware of, because a lot of people don't really catch that until the market takes a huge dip and they realize I had way more exposure than I originally had wanted in my portfolio. I think this is
the one
again.
You get to double up on.
So now we're going to start looking into some tax and some of the most common income considerations in retirement. So IRAs and 401ks, a lot of people have them. This is where you put money in, you take the tax deduction now, and when you take it out, you're going to be paying the taxes on it. Then with the Roth, it's kind of the opposite. You put it in, but that's on money you've already paid taxes on, so it can grow and grow and grow, and then when you take it out, there's no taxes. Pensions, those are starting to phase out a little bit more, but usually this just comes at a certain age. It can be based on your years of service, your ending salary, and then some kind of other calculations the company does, but then it will be a certain amount each month or each year that you'll receive. Brokerage accounts are similar to Roth, except in which it is after-tax money, but with brokerage accounts not being a retirement account, any growth or interest or dividends you're receiving each year are taxable. So that's something to consider. Social Security is, a big part of a lot of people's retirement plans. Rental and part-time can also be another source of income to help supplement your retirement, and then also self-employment.
A lot of colors in this one. I'll start at the right with the baby boomers. This one is kind of cool because you see the gold there, 16% more pensions. So as we go younger, you can see the pensions going from 16 to 12 to 6. And you can see the light blue lines. Baby boomers really relying on Social Security. That's becoming less and less, down to 20% for the millennials, which is good to see. And then you can see the 401ks on the two younger generations, the 28 and the 30s. So really, again, stressing the importance of self-savings for retirement, not relying on pensions and not relying on Social Security. So that's a pretty cool slide. The Gen Z, the Jake's age didn't make that slide. That's
Yeah.
right off the charts.
No one's even thinking about retirement. So some more income considerations. This is mainly a lot of facts and information about Social Security. So the median retirement age for Americans is 65. Now you can see that Social Security has kind of started bumping up their full retirement age. It's now closer to 67, but it largely depends on your birthday, just because people are living longer. And Social Security provides the majority of income for 64% of retired Americans. I think that leads a lot of people to kind of worry about the future, and if the current retirees are putting that much importance on Social Security, what will happen for us? We'll talk more about that, though. The average Social Security benefit is $1,503 per month. Again, nothing you can really live off of, but definitely some supplemental income for sure. 28% of Americans have no confidence in Social Security. We get this question a lot. A lot of people have questions, about the government, concerns even. One thing I like to point out to all of them is that for income, the Social Security tax only goes up to $169,000. So people making $1 million, as soon as they hit the 170,000, the Social Security tax just stops. There's only that max. So, I think that's a great way if for some reason the Social Security ever started kind of getting into some problem areas, they can just raise that taxes, which they do each year, but maybe drastically raise it in that event. And then 34% of Americans plan to rely on Social Security as their primary source of income. This has gone down a little bit now in future years as people are starting to focus more on their personal savings rather than just Social Security.
Taxability, tax planning. We do a lot of this, and before I joined this firm, tax prep was sort of, look through your fingers and hope you get a refund, not really knowing what you're going to get. So year-round tax planning and spend down analysis, we do a lot of. Roth conversion opportunities are something pretty cool in retirement, where there can be some gaps between when you retire and when you start your pension or when you start Social Security. You may be in some lower income years, and that's where you could take some money from your traditional IRA or your 401k, pay really low tax on it, convert it to a Roth, and then it's tax-free forever. So for a lot of our retirees, we do a lot of those Roth conversions. But again, that takes year-round tax planning to see what's happening in the other accounts, what kind of capital gains, interest, dividends you have, what other income sources you have, and then that Roth conversion makes a lot of sense.
And just to bring it back, we hear a lot about the financial calculators you can look up, put in how many assets you have, how many years you're going to be in retirement, a growth rate or inflation, and then it kind of spits out to you if it will work or not. One thing that a lot of these calculators don't take into account is taxes. So if you have all of your retirement income in a 401k, and you put that $1 million in the calculator, it's not taking into account the taxes you're going to pay when you pull that money out. So when you pull out 50,000, you might actually be receiving net 40,000. So if you need that 50,000, you actually have to take out more to cover the taxes to get just to that net 50,000. So that's definitely something to take into consideration.
Right? Is that what you guys are saying?
Yeah.
Yeah.
So really the decision of where to contribute is comparing your current tax bracket to what your tax bracket's gonna look in retirement. So if I'm at a high tax bracket now and I'm making a lot of money, I need the deduction now. I contribute to a regular 401k or a regular IRA, because if I'm at a 40% bracket now, I'm confident in retirement. Hopefully I'll be at a lower bracket. The reverse is true. So a lot of younger people just out of maybe college or just starting to work, they're at a 20 or 25% bracket. Makes sense now. They don't need the deduction. Put it into a Roth. Chances are 20 or 30 years later, the way this country's going, who knows where the tax brackets will stop. Probably going to be at a higher tax bracket. So really you're just comparing your tax bracket now to what you think it would be in retirement. If you need the tax help now, you do the IRA and the 401k. If you need the tax help, then you do the Roth. So we just chatted about this. They say Roth bases are always tax free. So if I contribute $10,000 to my Roth and it grows to 15,000, I can always take the $10,000 out, no matter what, no matter when, for any reason. That $5,000 would come at a penalty if I took it out before 5 years or before I'm retired.
59 and a half.
15, yeah. So,
And then
So would you just have to report that as
right. So when you get a 1099, they will show an amount come out of a Roth and they will automatically say, oh, that's taxable. What you have to do is say, hold on a sec, look down at the bottom of the form. That $10,000 I took out was my basis. I contributed that. So that 10,000 is tax free. The 5,000 of growth is going to be taxable and maybe penalized.
and especially for younger, people saving for retirement, it's better to go to the Roth first and start contributing right to that, because like he said, all that growth, that 5,000 of growth, isn't taxable. But if you're putting it into the 401k or the IRA, that growth will still be taxable when you pull it out. But if you roll it in, then you're kind of going to pay tax on that growth no matter what. So if I put in $10,000 into my IRA when I'm 30 and when I'm 60, I roll it into the IRA, all of that growth that was on that $5,000 is still in the 401k, which will be taxed. Instead, if I put that money right into the Roth, that growth over the 30 years is not taxable. Now we're going to look at some healthcare considerations. So Medicare, parts A, B, and C, C, D, some alphabet soup. So A is generally your hospital insurance. That's what that covers. And then B is more of your medical insurance. So that's more like doctor's visits and whatnot. D is kind of the easiest to remember for drugs. That covers all your prescription drugs and whatnot. And so you can choose to have A, B, and D, or a mixture of those three. And then there's also C, which are advantage plans. This is where it kind of adds A, B, and sometimes even D all into one plan. And even it kind of extends the coverage to provide you more coverage in retirement. And then similar to the Part C plans or the advantage plans, there's also Medigap, which just kind of takes that a step further and even offers potentially more coverage. COBRA has become a big consideration now for people retiring earlier. So before you're at age 65, if you retire or leave your employer, you usually have no insurance. So you have to either go to the healthcare marketplace or use COBRA. COBRA is just an extension of your prior employer's healthcare plan. So it can last up to 18 months, but something to consider is that sometimes you'll be paying the cost of it up to 102%. you're obviously paying 100% of the cost because the employer is not going to pay any percent of it anymore. But then you're also paying the 2% for admin costs that the company might be incurring for you to continue that plan. If you choose not to go with the COBRA, there's the healthcare marketplace. Each state has their own kind of website and where you can go shop this. It's pretty straightforward. You put in your age, information, income, and whatnot, and it'll give you options. But that's a great place to find insurance before the Medicare kicks in at age 65. Then, as Todd was talking about, long-term care, that's definitely becoming a consideration as people are starting to live longer and healthcare costs have been going up. Now we're going to talk a little bit about estate planning. This is always a big conversation we have with retirees. So why do you need an estate plan, and what is an estate plan? An estate plan puts in place, in the event that you're not able to speak for yourself or you've already passed on, who's going to make your decisions, where are my assets going to go, and what's going to happen with, just everything in your life. So generally the documents an estate plan includes are a will, you might have heard of. There's healthcare proxy and power of attorney. These documents elect someone to choose to make decisions for you in the event you're not able to. So if you're, have tubes all over the place and you can't make a decision for you with your financial life, or maybe your mortgage needs to be paid while you're in trouble, this person will make the financial decisions for you. Healthcare proxy is the same thing, except they make the healthcare decisions for you. What happens if you don't have an estate plan? This means you die intestate. Pretty much you're leaving it into the hands of the court. So, you hate to think of families being torn apart because of money, but I mean, without an estate plan, people can get really greedy and really want that money. And having an estate plan and seeing, maybe my mom wanted my brother to get, my dad's ring or something like that, it's a little bit easier to swallow rather than a court saying he should get it versus me, and it can cause a lot of problems. It can be drawn out, and it can cost a lot of money for lawyers and fees like that.
Yeah. This was something with estate planning. I know a lot of younger folks don't have all the estate documents in order, but some of the seniors and retirees don't either. So we spend a lot of time on that, just because, like Jake said, we think it's the responsible thing to do. It's a lousy meeting. It's not fun meetings to have, but definitely something that you need to do. The people we leave behind are emotional and stressed out enough, and if they don't have any plan to follow, it gets really rough. So estate planning is a real key.
And then here are some reasons why people don't have an estate plan. Number one is I'm not sure where or how to create one. I know recently there's been some websites where AI can kind of create you a document, or some digital law firms. I tend to recommend people stay away from those. It's better to get a professional, just like anything, financial planning, taxes. It helps safeguard some of your assets, especially with this being such a big part of your life, and especially your heirs' lives. I haven't had the time. People get busy, but I think it's really important to make this a top priority. It can cause a ton of problems and really put stress on family relationships if it's not in act. But and then I don't know which documents I need as a third. Financial planners can help you with this, especially, and then just the attorneys themselves can obviously help, and they'll ask you a ton of questions about your situation, family, what your goals are, where you want to go, and everything like that, and they'll be able to help you there.